technical items. We want to hear from you, so send in your questions in the Q&A functionality underneath the presentation window. Your questions are private, want to be seen by Skylar and myself. We'll keep our eye on them to make it as interactive as possible, but we can't always get to all questions due to the number of people on these sessions. We also have our usual written disclosures we are required to show. Everything Skylar and I talk about should be considered as educational and informational in nature only, and should be construed as a personalized trading recommendation. Any expressions of opinion that either of us make could change at any time based on market conditions. We look at a lot of charts, hence our clever name, but we do not recommend the use of technical analysis by any means as your sole method of investment research. We look at ETFs and ETNs to try to understand what's going on in markets and sectors, but if you're going to trade them, read a prospectus. We also look at futures contracts. If you're going to trade those, do read the risk disclosure document for futures and options. And with that, we can already see what's going on here, Skyway. They're rotating out of the value stocks and back into the mega cap tech names again. You can just see it right here on the, that is the story of today's market, I think. But let's start off with the usual news flow here. Just a couple of developments since our session yesterday. If you're interested, the keeper of recession data, the National Bureau of Economic Research, did confirm that the U.S. expansion peaked in February and called a recession starting in March. This was obvious, but now it is official. And of course, it ironically came on the day that the S&P went positive for the year. So there you go. This brings to the close the longest expansion of economic activity in U.S. history, which lasted 10 years and 8 months, topping the second most long expansion, which was when? Ended in March 2001, and that was 10 years long. So we beat that by 8 months. Secondly, the Federal Reserve said after our session yesterday that it will make terms more favorable for its new program to extend loans to small and mid-sized businesses, the Main Street Lending Program. The Fed lowered the minimum loan amount and raised the maximum loan limit. It also extended loan terms to 5 years from 4 years and will allow businesses to defer principal payments for the first 2 years instead of just the first year. Director, or rather Chairman Powell, said the program was designed to help firms rehire workers. He's confident, I'm quoting here, the changes we are making will improve the ability of the Main Street Lending Program to support employment during this difficult period, quote unquote. Interesting. So there's $500 billion in this facility, and they haven't even lent a dollar of it yet, though. It hasn't really formally opened. Also, just to put it into context with some of the other programs, we have the PPP, that's the Paycheck Protection Program. Those loans can be forgiven if they rehire workers, but these Main Street programs aren't forgivable. So what happens, though, is in this, the way the Fed is doing this, that again, it's going to be run by banks, but once the banks loan the money, they can sell 95% of those assets back to the Fed, freeing up their balance sheets. All right, moving on today, starting overseas. German exports declined by the most on record in April, tumbling by negative 24%. However, more current data, this is something that Jeff Kleintop would watch. We had the release of truck toll data to show what things are moving over there. And historically, this has been correlated to the level of industrial activity. And the data for the month of May suggests that the German factory system is coming back in a roaring manner. The toll activity for the trucks increased the most on record, but the records only go back to 2005. But anyway.
I was going to say it's kind of impressive because I know we were concerned, or Kleintop specifically was concerned towards the end of last year about a global recession just based on manufacturing data. So it's kind of interesting to see it coming back as strongly as it is, given that there was weakness prior to the pandemic and the quarantine. So.
Yeah, absolutely. Yeah, that's a really good point. All right, domestically today, we had the NFIB Small Business optimism index is slightly beat expectations. The JOLTS report didn't really do anything. The market usually doesn't follow that. Also, the Federal Reserve, of course, is starting its 2-day FOMC meeting. So as usual here on Charting the Markets, let's just do a little preview of what the markets are looking for that. Now, it's obviously expected that the Fed isn't going to change rates or its QE program. But what is the key unknown that the markets are going to be focusing on? It is what the Fed does with its forward guidance. And that's going to determine whether the meeting is taking as dovish, which would be a positive for stocks, or hawkish, which would be a negative. All right. So the expectation that we've talked about this over and over, we have this Fed put on the market. And that has caused this rally of more than 50% basically off the March lows. If that idea is put into doubt at all, you're probably going to see a pullback in the market. Is that likely to happen? I wouldn't think so, but it's 2020. We found that anything can happen, right? Okay. And another sign that the market's expectations are going back to the way they normally look at these meetings. Pay attention tomorrow to the dots. I think that's going to be the focus. If you're not familiar with that, it's the dot plot. Why don't you talk a little bit about that, Skylar? You're the CFA, what the dot plot is.
Yeah, it's the expected rate or path of rates over the next, a certain time frame. I'm actually forgetting the time frame, but they plot where they think rates are going to be at over the next, let's say, year or 2 years, and that versus what the market expects can lead to some surprises if people are looking, if some of the reserve members are more hawkish or dovish than others. So it's kind of what it's used for.
Yeah, good explanation. So the market feels, I think, that the dot plot is now going to be the mechanism more than the statement by which the Fed lets the market know how long they plan to keep rates at zero. So I think this is the forward guidance, the way that they're going to telegraph it. Just to give you an idea, if a bank knows that the Fed isn't going to raise rates for years, then the business can plan, right? So knowing the course of what the Fed thinking is going to be rates is pretty important. So what the market is expecting then, now that you know that we're going to be looking at the dot plot, what the market is expecting from what I'm hearing is no change to the interest rates or to QE. And the Fed says that QE will continue in, quote, amounts necessary, unquote. And the median dots show no rate hikes through 2022. All right, this is what's expected by the market. However, this is, I think, priced in already. Now, if in fact, though it does show no rate hikes through 2022, I think the rally probably could continue a little bit, even though most of it's baked in. So you probably get a continuation of the current trends, although I would expect performance maybe a little bit more balanced, so maybe both cyclicals and defensive rallying a little bit on that. I think Treasury yields would probably be unchanged, and again, this is expected. It probably wouldn't cause profit taking either. What would be negative? If they show a rate hike with the median dots, so that's the average dots, right, in 2022. Now, there's probably not a chance that the Fed is going to hint at ending its QE program. But if those dots do show that the FOMC see rates rising before the end of 2022, that's going to be taken as slightly hawkish by the market, and that would probably lead to some profit taking and a pullback, I would think.
I hadn't heard quite. It's interesting that you're kind of referencing the telegraphing through the dot plot, because it also would show kind of the potential for, I'd say, I'm trying to think of the term for it, but when you've got disagreement among some of the members, because like I'd anticipate Powell is going to continue to iterate his, supportive stance and approach. But if you start seeing others start to telegraph higher rates, and then you see what the median is creeping up, you could see that kind of indicate to the market outside of what just the actual statement is saying. So that makes a lot of sense. I like that.
Yeah, exactly. And so what would happen if in fact that, it's probably unlikely, but probably, the market would sell off, but I think you would get a rotation into, I think the financials would probably outperform because you'd have higher rates uh, on the horizon, and the dollar would probably rally too. I think gold would also get hit if that happens. And I think the 10-year could finally make its run for 1% if that happened.
Hmm.
What would the dovish case be? Well, it's pretty much baked in, but if they uh, some type of, if they say there is going to be an official interest rate cap or some pledge in the statement not to raise rates until a certain date, like in 2023, that's the way they could actually do dovish forward guidance beside the dots.
Hmm.
I don't think it's likely, but that's what I'm hearing anyway. I think, though, if they did come out explicitly and give an interest rate cap, that would be a dovish surprise to the market, and the market would probably rally even further.
Yeah.
Um,
I think at that
so,
point, that'd be a pretty bullish case then for gold in that case, right? As far as concerns over inflation over the longer term, if they actually put a cap on where rates could go, you could see that kind of difference creep up quite a bit. Is that right?
yes, exactly. So, what would be a wild card? Uh, what I'm hearing is if they announced a formal QE plan. Now, what do I mean by that? I mean that if they say, um, like the plans they did after the financial crisis, where they actually say the total. Remember, the QE right now is in the amounts necessary, right? That was the last quote. So if they give an end date, or they say we're not going to do more than 500 billion, let's say, over the next 6 months, um, that would probably be a little bit negative on the market because the market is kind of uh, relying on we will do as much as needed, which is the Fed put. Uh, so anyway, that's probably not going to happen, but that would be the only wild card in there, I think. All right, let us move on and start looking at some charts.
Tis part of the name, I think.
It is. It is. So got a little pop in gold because the S&P is down a little bit. We've been saying front contract now is August. How do I know that? Because I asked Mike Zaremski. So there is your support level, range bound, basically here on gold and probably the gold miners too. Okay.
In this one, I mean, to see any meaningful move higher, we'd have to have some sort of reemergence of the virus, you think, or is this more of inflation kind of oriented at this point? What do you think?
No, I think it is the safe haven trade is more because um, that's that's what I think.
That makes
It's more this, yeah. Um, I mean, what has been puzzling a little bit, and Mike Zaremski is our futures guy, and we talk about this on Thursdays, is that the dollar has been going down, and gold really hasn't rallied on that like you would think.
Mhm.
So that's a slight negative. Um, anyway, this looks like you broke a head and shoulders, but it also looks like now we've just rallied into resistance. Keep your eye on the 50-day moving average. So at best, this chart is getting to be neutral. Um,
Isn't that? I mean, when you break below the neckline, don't you usually get a rally back to retest before it falls lower, or is that different? Am I reading that wrong?
no, you're absolutely right. Even though you're a CFA, you know how to look at charts. That's good. That's good.
I'm
Generally
on charting the
speaking,
markets. Yeah.
yeah, exactly. Generally speaking, head and shoulders often, almost 50% of the time, do what's called a throwback to the neckline. So maybe that's what we're seeing here.
Hmm.
Good, very good point. Let's take a look at silver now. Again, it's getting more range bound. I think you get the support is an area, if you want to stay long, I think many technicians would say as long as it kind of holds this area between the 200-day moving average and the bottom of the flag there, so right in here. We could put a rectangle in there, so that I think that's the key level you want to watch there. That's about 17-ish dollars on silver. Okay. Let us go take a look at the silver miners, see if they're acting like the gold miners.
While you're pulling that up, the last
Yeah.
time we were on, there was we had seen more of a convergence where silver was then leading gold. Is that kind of maintaining, or has that leadership changed at all?
It is normalized a little bit, and let's take a look at the chart of the gold-silver ratio to see it. So you can see it is normalized quite a bit.
Wow.
So we had pointed out that this was way out of whack, and then maybe silver will catch up, which it did. But now we're back more to normal levels. So I would say if you're trading because the ratio is a little out of whack, maybe that move is over a little bit. Yeah. Okay. Let us take a look at the doctor. Been good news on the doctor. It has been confirming the rally here. And second day over the 200-day moving average. We are running into a little bit, though. There's your next potential target on copper. It's about 264. The good news is that it is moving in the same direction as the market. What we don't want to see is the market continue higher and this start rolling over. So that's why we're watching copper right now. But right now, it is confirming the market rally. We have a question. Let's go back to the GDX. We have a question on Head and Shoulders. Now, if you wanted to, so a couple things. If you wanted to get even more specific, whether this is a good or bad Head or Shoulders, I mean, you can also look at the volume pattern. And I haven't looked at it, so we're going to look at it together. But what technicians want to see, if it is an actionable Head and Shoulders, I mean, you have a better chance of it working if the volume is generally falling as you go to the right. So let's see if that's true.
Yeah.
Well, it's not going up, right?
Yeah.
So
in this specific case, would you wait for a fail at the 50 before trying to do a trade, or do you think as long as, or just put a stop above, supposing you're short, you're just putting a stop above the neckline?
I think I would do it in two steps. I think I would, I would wait to see it fail at that neckline. I'd like to see it start going down again because we've had a rally now for 3 days. I'd like to see that start to get reversed and go down again. Then I would put a stop above the high of the day that happened, which could be today if it got weaker. And then I would add more to the short if it broke the 50-day moving average. So I wouldn't take a full position because the 50 is right there. But if we broke the 50, then I would, because the downside target is, again, measured moves don't always work, but roughly 33 to 38, that's 5 points. From 33, that's 28. That's where I got the line down here. That's also the 200-day moving average, which seems to me a likely place that, they try to stop it from going down. So we don't have volume confirmation in the classic sense, but on the other hand, we don't have volume saying it's not true, right? If you saw volume increasing across that, then you'd be less likely to take it. All right. All right, let us go and take a look now at the oil. I didn't have time to look at the EIA report. So all I know is the chart. We had broken out of this inverse Head and Shoulders, and looking for support here. The 50 is too far away. So let's take a look at the 20-day moving average. I think that's the predictive one on this.
Mm-hmm.
Also, I think if you're long oil, you can stay long unless it breaks 35 right now. Because you'd have to break the neckline to do that, and you'd have to break the 20-day moving average.
Is there, I meant to ask with this, because of the activity that's happened, or I think I was reading that there's quite a bit of net speculative positions on oil right now in the front month contracts, like in a very large amount. Is there concern that they'll have to all close out before expiration and that moves the market, or do these track separately then? If that question makes sense.
I don't think you have the issue anymore that you did when you had the long squeeze on in the May contract.
Okay.
I don't think that's there because the storage in Cushing, Oklahoma is not full. So
Normalized now. Okay.
yeah, it is more normalized. Yeah, so I don't think that's an issue. However, when you have a big speculative long position, if you do break the level, the selling, as the trend followers get out of that, you can have a pretty good move down. But the chart is not suggesting that is happening yet to me.
Fair.
All right. Dean in Indiana wants to look at the 2-year Treasury. Yeah, let's take a look at that. That's the one that Jeff Kleintop was talking about. We had a pretty good rally in the 10-year yield. We're going to talk about that. Let's just take a look at the 2-year here. Well, the slope is turned up. You can't. I don't think that. I think you got. I think you'd have to take out a quarter there. 25 basis points. I mean, it's turned up a little bit, but on the other hand, okay, you made a matching low, basically. That's good.
Yeah.
But it's still, the jury is still out. If you are following Jeff Kleintop, though, what was positive for the market was, remember, he was looking at the ratio to show kind of more risk on automobile stocks to household products stocks. And we told you a while ago that had kind of triggered in the favor of the rally right in here when we broke out of this triangle. This is that ratio. And you can see once that happened, how the market really took off, right? This is the S&P up here. As soon as that ratio broke, market took off. So now we'll have to see if it starts turning back up big time again. But so his idea to watch that was a good idea, is what I'm saying. Not that he needs praise from me, but he is our chief global strategist. So, all right.
You did just put out a mid 2020 outlook, and it was a little bit more bullish than the original one was in December for 2020. So that was good to see.
Yeah. All right. Let us take a look at the stock market. All right. Before we go into the reason, for what it's worth, I think we might have a little short-term weakness. I don't know when it'll start exactly, but longer-term bullish. Why am I saying that? All right, let's talk about the longer-term bullish case first, okay? So obviously the S&P, we are running into resistance. So this is kind of a key level. Is this where we might get a little bit of profit taking? Hard to say, but let's look at the long-term bullish case first. And what I want to point out is this. I have this chart built, and we are going to look at all right, that is the full, not the common stock only, but the full New York Stock Exchange advanced to decline line has just made a new high.
Wow.
Okay. So what does that mean? Well, of course, we looked into this, and let's look at when I think this when it's made a new high for the first time in months after a drawdown, it has mostly been a good sign. It's kind of a toss-up for the first few weeks after that happens, but starting at 3 months going out a year. Now, this is from data from 1940 till now. You're up 0.75%. I mean, 75% of the time, 3 months, 6 months, and a year out. Now, obviously, some people say going back to the 40s is too far back. Just let's look basically from 1990, so the last 30 years. Again, kind of a toss-up for the next couple of weeks, but 6 months later, you were up 87% of the time, and 1 year later, you were up 93% of the time. The only one that didn't have a positive rate of return was in 1994. So that is a good long-term signal. You have this huge participation. Now, as I said, that data suggests you could, it's a coin flip in the short term, right? A couple weeks. We just went over that, right? And add to that this. Okay. So when did the market peak? February 19th, right?
Mm-hmm.
Okay. So if you look back then, you look at the behavior of people that theoretically don't know what they're doing, which is small option traders that trade less than 10 contracts. They bought to open 7.5 million call options on equities. Okay. Speculative excess.
Mm-hmm.
What did they do this week?
The same.
They bought 12.1 million call options. Okay. And if you include ETFs in those figures, not just on individual stocks, 14.2 million versus 9.3 million in February. All right. So, and it's also not just small traders. If everybody is kind of into this, if you look at traders of all sizes, speculative call buying jumped to 35.6 million contracts last week compared to only 28.7 million contracts in February. All right. Now, let's also look at in percentage numbers. Okay. Small trader call buying, defined as number of contracts 10 or less, made up 50% of total option volume. When was the last time that happened? 2000, unfortunately. We know what happened then. So backtesting shows that when that is above 45%, forward returns were quite lousy. Also, 47% of option traders, the volume was on speculative strategies as opposed to hedging strategies. So that is a short-term negative. So you pair that with the fact that even when you break out of the advance to decline line at highs with that other data I gave you, long-term good, but maybe we might have a little bit of profit taking. That's all I'm saying.
Fair. Do you have smart money, dumb money by chance?
Why, yes, I do.
I was gonna say, because that one's, I mean, what you're kind of describing is eerily similar, but it's more specific with like the trades, it looks like, as far as call options. But
yeah, smart money, dumb money, there is now a 30% spread. It is 79.47. So smart money has declined to 47, dumb money has gone up to 79. Now, in the past, over 25% gave you a little bit of caution. The only reason I'm not so bummed out is that the last AAII data, which was last Wednesday, we'll get the new one tomorrow. That survey of the little guys, they were still not at bullish levels. But this data suggests maybe we'll get a little bit of a pause. That's all. So anyway,
Fair.
for what it's worth, take that. And what do you think? I showed the NYSE. Can you elaborate what stocks are in the NYSE in relation to the S&P, NASDAQ? Sure. That this has. I'm looking at the combined advance to decline line. So that has ETFs, closed-end funds, and that type of thing. Okay. All the stocks, in the S&P are also traded on the New York as well. So it includes now the common. We can look at the common stock only New York Stock Exchange advance to decline line. However, for the purposes of the back testing, the other one's a little bit better. But let's just take a look at the common stock only and see if that broke out. I didn't actually check that, but we'll take a look.
And one quick note on that question while you're pulling that up is the S&P 500 and the Russell 2000 are indices that are tracking what a basket of stocks are doing. Whereas when we're talking about like the NASDAQ, we're talking about the exchange that it's all being traded on. So you'll have S&P 500 and Russell 2000 stocks that are being traded on, let's say the NASDAQ or traded on the NYSE, but they're not kind of in the same sphere of, I'd say, as far as descriptions go. But go ahead.
Yeah. So not quite the same, but
still,
it's still, yeah. All right. Is the VIX telling us anything? Well, let's take a look. We noticed, I think it was it yesterday, that the market was up and there was a little, the VIX was up yesterday, right? Even though the market was up. So they were hedging up there. Let's go to that other chart I showed you last week, which also just makes me a little cautious in the very short term. I'm going to show you this chart and why. There we go. Notice that we got down basically to the 23 level and unfortunately bounced up. That is very similar to what happened in March. That's why I've got this green line here. So again, to be really confident in the very short term that we could rally further, you would have liked to see the VIX break this support level, and it didn't do it. So again, just a tiny bit of maybe short-term caution. Which means you can see the VIX was up yesterday and the market was up. That means they were doing more hedging. We'll see if they're right. I don't know. All right. Anyway, that is the smart money, dumb money. We just talked about that. It's 47.79. 47 smart, 79 dumb. Okay, let us go take a look at the NASDAQ.
Look at that chart.
Yeah. I mean, that is what's going on today, though, right? You are rotating back into mega cap tech. So is that almost a defensive play? I don't know. What do you think now? To a certain extent, it might be, right?
It seems like, as far as, they're liquid, they're the go-to positions, they make up the largest portions of most indices now. They're all in the NASDAQ. Like, it makes sense. It's an easy position to get in and out of. It's also one that, when people think of names that you'd want to hold with uncertainty, it's a lot of those tech companies, because as we saw with the uncertainty that happened, we all gravitated towards needing our technology more than anything else. So it makes sense that it's a bit more of a safe haven play than it traditionally would have been seen as, right?
I think so. Now, interestingly, we've gotten this question all the time. What happens if you take out FANG? I've got a couple of ways. There is no index specifically that is like the S&P 500 or the NASDAQ 100 minus FANG. However, I'm just building up the suspense here.
I was going to ask if you're going to equal weight them or if you know some way of.
I'm gonna do something even better.
Ooh.
Okay, let me get my watch list here.
You did stock splits with 496 companies. Is that what you did?
What was it? Oh darn! I thought I had it here. Hang on.
This is where you've got too many.
Too many tabs. See if I could. Darn it. Let me see if I can remember this symbol. It's RSRV. No, it's not it. If you give me 1 second, why don't you opine about? I'll put up the cues, and I do want to talk about this. So I
Yeah.
thought I had it. So I'll put up the cues, and let me just go look it up real quick.
Sounds good. What I'm not a whole lot to not like about this chart. I mean, clearly breaking out previous support or previous resistance levels. A little bit of a retest yesterday, even, and can't argue with the candle for today as far as strength or ending on strength. But big picture, it was Randy Frederick had an article out on Friday, the not charting the markets, it's weekly trader outlook, and it's kind of an interesting conversation, but it's basically was saying both between the S&P and the Qs and markets based on trend, you'd actually expect to be at all-time highs very quickly here, just based on the moves and the directions for things. So it's there's not a whole lot not to like about this, other than it's clearly almost it just going too strongly in one direction. So you kind of expect to see some volatility sneak in at some point, but that's just more of mean reversion questions. So
Okay. Here we go.
you're off by like a letter or two.
I was off by a letter. Okay, so you know that the S&P is market cap weighted, right?
Yep.
This is reverse market cap weighted S&P, where they give. So this is absolutely the opposite. Okay, and to see how it's. So what this basically is, it is this again is reverse market weighted. So what it does is it lowers the overall PE versus the spiders, and it gives you the same 500 stocks. It just really undoes the overweight of FANG.
Is it based just on market cap? Because
yes, reverse market cap.
So it would give outsized weighting to the smallest companies in the S&P then. Okay.
Correct. So it is kind of interesting. And then let's see what's in there so you can see the difference for the weightings. Yeah, see, these are not your right. They're given the most weight to like these companies, So anyway,
does it I'm still kind of processing what that entails entirely. So you'd give outsized weightings when the lowest or the worst performers, if
the worst performers are doing better than the big ones, this would move faster. Yes.
Okay. All
right. Let's look at the Russell. And then let's take a look at the breadth of the Russell. Yeah. And also, so what we're going to do is we'll take a look at the Russell itself. So you got to say it sold off. It tested the 200 maybe. So this is good. Now, what we're going to do is compare it to the equal weighted small cap index. So we're going to do a price relative here. There we go. And that is EWRS. So this would be this S&P small cap. I'm getting my symbols, man. Sorry, EWSC. Sorry. So this is kind of interesting too. It's showing that you have, even in the Russell, they're going to the bigger names.
Yeah.
Right. So
makes sense. Well, the Russell makes the most sense to me as far as balance sheets, debt loads, and everything else. Like flight to quality, I would expect the larger ones in the Russell to have quite a bit more emphasis, but I guess that tracks in.
So we have a question on market pullbacks that followed the high speculative call buying in February were quite a bit weaker. Would it be fair to infer that the advanced decline information is for the longer term? I mean, people aren't buying speculative call options to hold stocks for a year, right? They're just not doing that. It's short term. So anyway, so I'm just saying short term, based on that, there's a little bit too much froth. Now, on the other hand, smart money has been right off the bottom. I mean, dumb money has been right off the bottom to a certain extent too. So I'm just telling you that that's what I'm watching. So maybe a little short-term weakness, especially if the Fed has some wild card or something. But longer term, we've had so many of the thrust type action. As a matter of fact, I showed you yesterday, if you weren't on, that we had another Marty's lag, not the breadth thrust, but we did have the 9 thrust. Let me show you that. That was the up volume indicator on the, see, we've had 2 now. That means most of the volume was 90% of the volume was on the upside. So we have conflicting things in the short term, longer term. It's still
good.
positive. Good. Yeah. So what does that mean? It means you take a little profits quicker, but you tighten your stops just a little bit. That's all.
Yeah.
All right. Now let's look at what do we get? We have 1 more minute. Let's just see where the sector action is really moving today, and then we'll stop. So the airlines are taking a hit today after the big run up. Let's go the other way, see what's moving. Looks like the biotechs are moving, right? Genomic, cancer. Let's take a look at the biotechs. It's always a good way to see where the action is every day. Yeah. So you got a pretty nice, symmetrical triangle here. Look for the breakout here on the biotechs. And let's look at the small ones. Yeah, not quite as pretty a triangle, but in the same thing. So keep your eye on that one on the long side. We had the airlines having some profit taking after the big run up. I'm not having symbol issues today because I'm under the weather, I think. Yeah, so they broke out a little bit of a pullback. And somebody wanted to look at the home builders. Just
the wrong symbol.
Again, right? Yeah, they've been on a tear.
Yeah, they have.
Just a little bit. We had a little bit of dark cloud cover yesterday, which suggested a little bit of a pullback, but I think short-term support there is at 44-ish. So anyway, unfortunately, our time is up. I did want to share all that kind of stuff with you, though. And then coming up next is we have
introductions to futures
trading. Yep. With Mike Zaremski and Joe Schulte. So if you're not familiar with futures, stay tuned. Thanks so much, Doris Gower.
Thank you, Lee.
Okay.
So Schwab taught me about four-legged option strategies. I'm going to go with an iron butterfly spread on that fintech